Good evening, everyone. Thank you for joining us today for a discussion on ESG. I have with me today two very special guest speakers, Mr. Yasunori Iwanaga from Amundi and Mr. Mervyn Tang from Schroders. So we just want to get started, but first of all, I just want to point out that we do have a Slido link where you can go in and you can ask questions to our speakers or people at Endowus. So please let's make this discussion exciting, lively on ESG. And in the next few slides, I'm just going to introduce Endowus very briefly. I know we have a lot of existing clients, but there are also a lot of people who are not as familiar with Endowus. So Endowus is a digital wealth platform and advisor. We offer a fee-only wealth platform. Our management team here, you can see a lot of them, is made up of very experienced leaders from different industries and a variety of organizations. And most of you may already have heard or seen Sam and Greg in action. Sam is our chairman and CIO, and Greg is our CEO. Our clients choose to work with us for three main things. The first is the quality of advice. We have a team of investment professionals who put together a curated list based on their experience, deep due diligence with fund managers, and also cutting edge research. We look at other people's reports, we discuss. So it's a lot of institutional experience that goes into coming up with that curated list that you see on FundSmart. The other thing is access. We provide access to institutional share class funds. So institutional share classes are actually typically reserved for institutional investors, but they tend to be the lowest share classes available. And so we try to work with our partners to allow our clients to access these institutional share classes. And the third is cost. We don't have a sales charge, we don't have a transaction fee, and we try to negotiate to make sure that the trailer fees are rebated as much as possible to our clients. So we want to make sure that you're getting all your nickel, dime, dollars and cents all back into your wallet. So that's us. And here are some of the leading fund managers that we work with. I'm sure you recognize most of them, if not all of them. Schroders and Amundi are part of this group here. And because this is a session on ESG investing, I just want to also just mention very briefly that we do have ESG advice portfolios available on the platform. So if you're interested, you can definitely go take a look at it. First of all, I want to introduce our two speakers. The first is Mr. Yasunori Iwanaga. He is from Amundi. And he was actually the CIO, but now he's the Chief Sustainability Officer. And the second here you see is Mr. Mervyn Tang. He is in charge of APAC for sustainability at Schroders. So with that, I'll first hand it over to Yes-san to introduce Amundi.
All right, thank you, Min. Good evening, everyone. My name is Yas Iwanaga. I am actually based in Tokyo. And on behalf of Amundi Group, I like to make a brief introduction about ourselves, Amundi. Well, we are a top 10 global asset manager, and AUM-wise, it's about sort of $2 trillion US as of now. And we do have a decent presence in this region here, Asia. And like you're seeing on this slide here, we have subsidiaries, including ourselves in Japan, but also joint venture with local financial institutions in China and India. And if you move on to the next slide. Oh, sorry. So this is a sort of a brief intro, and just one sort of comment. Well, Amundi, has responsible investment as one of the 4 founding principles. So we have a long history, but I will touch on that a bit later. Thanks.
Next, we have Mervyn from Schroders.
Hi, everyone. Really glad to be here. I'll give a quick intro of Schroders. So we're an asset and wealth manager. We operate globally in 38 locations. We have 8 offices in Asia. I'm based in Singapore, but I cover our activities across the whole of APAC. So we have $939 billion of client assets under management, catering to institutional clients like pension funds, as well as intermediaries. And we have a wealth business catering to charities, high net worth individuals, affluent individuals. Now, in terms of what we're doing in APAC, we've been absolutely expanding our sustainability capabilities in the region, building a regional hub. I think that recognizes that clients are becoming more and more interested in APAC on how to implement sustainability, thinking about issues like net zero. And it's absolutely crucial to have that on the ground presence to be able to do sustainability well here. So very glad to be here to talk about ESG today.
Well, thank you both for the quick introduction. Since we're talking about ESG investing, I think it will be very helpful for our audience to understand how Schroders and Amundi approach ESG. So Mervyn, maybe you would like to start first. Could you please spend just a few minutes on ESG at Schroders?
Absolutely. So I guess we all have very similar slides when it comes to these asset managers. So we have over 20-year history when it comes to sustainability. So we hired our first ESG resource back in 1998. And I'm sure Yaz would tell you as well, ESG has evolved a huge amount in that time. What we do in terms of has moved way beyond screening to integration, to private assets, to engagement strategies. There's a huge amount when it comes to evolution of sustainability. And I think we have been trying to really build up our capabilities, acquiring things, something like natural capital research to build our natural capital assessment capabilities and the ability to analyze biodiversity risk. We've acquired something called Green Code Capital to improve our investment in sustainable infrastructure. ESG is moving goalposts, which we are absolutely trying to keep up with. Now, you will probably hear about every different asset manager's proprietary approach. I think one thing we get asked a lot is why even have a proprietary approach and not just take an MSCI or Sustainalytics third-party provider? And I think there's kind of 2 reasons for this. The first is any sustainability methodology will have specific ways they aggregate data, the choices of data they use, as well as what objective they have. And so when you hear that, when you hear all this kind of media talking about the lack of correlation in ESG ratings and the confusion in the industry, I think there's a reason why there are these differences in perspective. And in many ways, you would want that because if we're talking about non-ESG and financial aspects, you wouldn't expect every asset manager to have the same valuation and the same view of the growth and value of a company. Now, at Schroders, we think that you can't necessarily rely on one ESG tool that can cater for all needs because there's a lot of different climate objectives. Some are trying to think about, let's say, just purely climate risk assessment, understanding what's happening with transition risk and physical risk. Some might be thinking about how to align their portfolio to, say, sustainable development goals. Some may be thinking about more qualitative analysis of how do you think about companies' policies. Some are going to be focused more on metrics. And so what we do is build up a suite of tools. So SustainX is kind of our most famous tool, but we have a range of other tools like that's a climate analytics framework, Context. They all offer different perspectives on sustainability. None of them can offer everything in one go, but we use these together to be able to craft ideas for our different investment desks, to be able to apply them to specific investment strategies. And that fits into a whole spectrum of the investment process, investment decisions, active ownership in terms of engagement and stewardship, and outcomes reporting. So how can we tell our clients our sustainability profile of our funds as well as other ideas? And so that's the core, I think, why we have so many different sustainability approaches.
Thank you, Mervyn. Now we'll move on to Amundi, and Yes is going to talk about Amundi's approach.
Sure. Well, I wanted to take a second mover's advantage, but maybe sort of Marvin has got the first mover's one. Nonetheless, let me try. Our history sort of goes back to before 1990, and it was when the people it was the only niche in this industry, and we started the first ethical fund, and those were the day the area was called SRI. But like I said, we have a kind of a ESG/responsible investing DNA, in ourselves, and we have a long history. And as you can see here, and well, one of the things I wanted to sort of highlight here is, yes, we've been sort of trying hard to deliver solutions for those, in the responsible investment arena. But the other thing, I like to mention here is we also sort of have partnered with international organizations to create a new markets. For example, we have a sort of partnership with IFC, and we sort of launched the first the global, green bond fund in the emerging markets. And at the time, the sort of the presence, green bond presence in there was sort of almost non-existent. So we sort of worked with the IFC and help issuers to sort of have the right levels of disclosures, and also we are sort of reach out to potential investors to sort of discuss the importance of having such system in place. And we did the same for the other sort of institutions listed here. And so we received the sort of good enough sort of recognitions, like sort of things laid out on this page here. Next slide, please. Oh, maybe I should skip this one and move on to the next, Min. Thank you. Well, Marvin has, talked about the, rigorous approach of Schroders, but we do have a sort of, we have our own sort of, ESG rating system. And as of now, we have about 14,000 issuers globally rated with this approach. It's just a combination of external data as well as internal sort of resources we have. And we have contracted with more than 10 data providers, like Marvin saying, their ratings are uncorrelated, but it's a reflection of different values or different ways to evaluate non-financial aspects of the corporates. And we grab those in the data, and also we have a 20-ish sort of ESG dedicated team of ESG analysts, and we have they have developed the materiality map or table, like you're seeing here, and we sort of evaluate the individual data providers' quality and relevance to the way we like to evaluate. So if you take a look at the the floor on your right hand side, you have sort of a little sort of a numbers, and they are weights the analyst team have determined on each and individual data providers. Okay, and we have a sort of materialities, and depending on the sectors, they have a different meaning, different significance. Therefore, we have a different set of weights, and we aggregate them to reach a sort of one single sort of a final score. But we can use use them as an aggregate, and also we use them as a separate to sort of better reflect the portfolios in response to investors' objectives. So this is kind of approach, and we have a sort of more than sort of 800 billion euro as recognized as a responsible investing. That's our approach.
Thank you, both of you, for sharing your approaches. It's definitely very labor intensive, and it seems like you have dedicated a lot of resources and money and analysts and talent to ESG. So that's great to hear. Thank you for that. So to set the stage for the next part of our discussion, maybe we can just talk about what's going on in ESG currently. So on this slide, you see two charts. The one on the left with the bar charts, just single bar charts, ESG investing, total AUM, the ESG investing, and this is ESG related investments. So not just funds, but just related investments. It's projected to reach about $40 trillion at the end of this year. So that's a lot of money. On the right-hand side, you see the inflows into sustainable funds and ETFs. So from 2019 all the way to 2021, you see a sharp increase. So there's definitely a lot of interest in ESG, and it's growing, it's still growing. So that's good to see, I think. But what's the most important thing on everyone's mind is how have ESG investments done this year? And so we compare the S&P 500 ESG versus the regular S&P 500, the MSCI World ESG Leaders versus the MSCI World. And year to date, the returns, S&P 500 ESG versus S&P 500 is pretty flat, and similarly for MSCI World ESG Leaders as well. So it's a bit disappointing for investors because ESG companies did not outperform non-highly rated ESG companies. And that's what we have seen over the past few years. ESG companies have done much better, but for this year, it's been disappointing. So there's been some backlash. ESG investing is getting more criticism. And so now we pose a question to, how about we start with Amundi? Yes. Maybe how should we go about investing in ESG in this environment?
All right, thank you. Well, first thing I would like to mention is that, ESG investing is investment. And, if you sort of try to incorporate the sort of ESG factors into a portfolio, it's bound to have a certain biases in one way or another, right? And like any other sort of investments, ESG investing is also exposed to a certain sort of a style rotations or industry rotations and whatsoever. And so that's a sort of a fact. And the other thing sort of we should bear in mind is that especially over the last few years, 2-3 years, ESG is in, and people started sort of incorporating those new pieces of information, and which prices have reflected. So in a sense, it's a sort of kind of a reaction as a result of stronger demands in light of supply. But that's that. But important thing is that, okay, you have to go back to your investment goals. And what are things you had in mind when you sort of picked and chose your ESG investing? And depending on the sort of objectives, you should have a sort of right standard or right criteria to evaluate your ESG investing outcome. It may be sort of different, longer investment horizon when you really evaluate your sort of result. And so this is something sort of we should bear in mind. And again, ESG takes a sort of longer term view, and why not sort of we sort of be patient and look how it goes. And everybody should understand that all those sort of behavioral changes will take time on the corporate side, and also it'll take time to all those sort of good practices in E and S's translate into actual economic outcomes or sustainability of their business models. That's my point.
Thank you, yes. What about you, Mervyn? How should investors think about ESG right now? Should they just be buying energy companies?
So many things that could be discussed in this topic. It's funny, when you showed me that slide with the MSCI ESG index and then the S&P ESG index, and you said, this shows me ESG investing underperforms. I would have a slightly different interpretation. I would say that slide shows me MSCI World ESG Leaders, which uses MSCI ESG ratings, which uses a particular selection process with those ratings in terms of sector neutral and then picking the leaders in a particular sector. And that shows me underperformed for a period of time. Now, if you look at some of the data, let's say a few years ago, it would show you some outperformance over a period of time. And that's going to fluctuate in any situation, in any environment. And of course, that MSCI World ESG Leaders is going to have factor exposures, be it growth, be it some other aspect, because of the way it's constructed. Something like the S&P index, or some other ESG strategy can potentially have different exposures. Now, of course, when it comes to the broad spectrum of ESG strategies, you will have some maybe more correlated concepts, maybe an overweight in renewables because of the focus on carbon intensity, maybe certain stocks that are like, let's say the UNGC violators list that would not be included in a lot of these funds. But the key thing is that there is a huge variation when it comes to these types of strategies. And I think that makes it really important for investors to understand what they are being exposed to. If I'm buying a SDG fund, that is going to have some climate exposure because it's one of the SDGs, but it's very different exposure to an alternative energy index stock or a stock that is, let's say, carbon neutral or like Paris aligned with a particular carbon intensity process. And so if I'm an investor, then I need to understand how does the choice of ESG strategy affect my potential risk return profile and under different circumstances. Now, the second point I would like to make would be the difference between ESG analysis and integration versus sustainable strategy. ESG integration, we believe, is in some ways an extension of financial analysis to incorporate maybe traditional data that was non-traditional data or data that was typically not used before. And I think that reflects that we have this huge influx of disclosure, carbon, like companies with net zero targets, their carbon emissions data that we never had before, their ecosystem exposure with what we're seeing with biodiversity data. There's a huge influx of data that is coming through. And as a response, as an investor with who needs to comply with our fiduciary duty, we need to look at this data if it's financially material. And for me, I think when we talk about is ESG relevant now, and like the conversations about inflation, about the conflict, I would say analyzing ESG factors has become even more relevant because in an inflationary environment, a lot of stakeholders are going to get hit. There's going to be workers in your company who are going to be asking, oh, should I be getting paid more? Am I being treated fairly? And hence analyzing whether companies have adequate policies and management processes to deal with it in this inflation environment becomes crucial. When it comes to this energy conversation, with what we've seen in the Russian-Ukraine conflict, there is a whole conversation about energy stability. How should governments be investing when it comes to ensuring that they have energy now, but also how can they avoid being dependent on fossil fuel and fossil fuel producing countries in the future if there are further conflicts? And then so there's a lot of questions about how we see the future development of green and renewable energy investment and energy mixes in the future. Again, that makes it even more important to analyze some of these issues. And so I don't think ESG investing is going to go away. I think ESG analysis is just going to become an even more important part of our processes.
Thank you. Very, very insightful. So just to recap, yes is saying that you should be thinking long-term. You should be revisiting your goals. For, when you invested in this particular strategy, what were your goals in terms of ESG and in terms of performance? So just revisiting that and thinking long-term. And Marvin is saying, look into the underlying data, because we're seeing some of this, the indices that Marvin said a lot of things, but this is just one of the things that he talked about. And the indices, the returns that I showed, they're not necessarily representative of how ESG companies have done in general, because that is using one data provider's methodology. So very, very helpful. And this is just a question that I would like to throw out to the both of you. Do you think that perhaps investing in a fund that focuses on E, a fund that focuses on S, a fund that focuses on G, maybe we can throw G out for now, since everybody incorporates G, and combining it is more effective than one fund that has a focus on all three?
Can I make one comment? From a diversification perspective, I think having this sort of different angles and in your sort of portfolio should help to stabilize the performance again over the long run. But you should understand that what is behind the E focused funds, likewise the S focused funds, and you should understand the their sort of futures in terms of sector exposures, industry exposures, if we can sort of evaluate the style factors, then we should bear in mind. But sort of having them sort of together again helps you to diversify your investment.
I would add, so when it comes to how you invest in ESG, I think even if we say an E fund and an S fund, any E or S fund could have very, very different risk and return characteristics. A fund that focuses on the decarbonization leaders in an industry is going to be different to, let's say, a fund that is just committed to reducing their carbon footprint by 50%, is going to be very different to a fund that's focused on alternative energy technologies. And so it becomes important, regardless of what the E, S, or G label is, to understand what the exposures are. Similarly with social, you could have just transition, you could have inclusion, you can have a lot of other issues. Now, putting things together, I think I completely agree with Yaz's point. Like any portfolio construction, you need to understand the correlations of these funds. You need to understand how these exposures, okay, if I'm exposed to one, what does it mean for my exposure to the other? How do I manage my portfolio as a whole that meets not just, I guess, my risk and return requirements and exposure requirements, but also the sustainability objectives I may have. And so some may not have any sustainability objectives. Some may be wanting to invest in environmental causes or social causes in particular. So there's a lot to be considered for a particular client when it comes to how to construct a portfolio.
Can I add one comment? In addition to sort of, the levels of ESG ratings or ESG scores, you should bear in mind that how those scores or evaluations evolved over the course of the time. And in our experience, for those companies, who've been really serious about changing the behaviors, and then as a result, they are getting to better sort of a market evaluation in terms of ESG. They tend to sort of generate, or their sort of behavioral changes tend to sort of translate into economic returns. So in other words, in addition to levels, we should think about deltas of ESG sort of ratings or scores. And well, in Amundi, we call it ESG improvers.
Great, thank you very much. And it seems that you have convinced our audience, because we have a poll going and it says 92% believe in ESG investing. So that's great news. All right, so for the next part, we are going to talk about everyone's favorite G word, greenwashing. Some people, they're saying that ESG stands for environment, social, and greenwashing. So with that, as an investor in a fund, we know that there are two layers of greenwashing that we should consider. The first is going to be, what fund managers do and the companies that they're invested in. Are the companies pretending, or just, is it just marketing, saying that they're doing all these corporate sustainability issues and all this stuff? So first of all, I think I'll probably throw it out to Mervyn, maybe to answer this question. For the companies that Schroders is invested in, do you think greenwashing is a very serious risk? Are you seeing a lot of that? What's the trend?
I think it's a complex question that I'm going to arguably overly simplify into two aspects. And so I think, like for companies as well as for funds, there's two aspects to, I think, greenwashing. The first is differences in views on what is sustainable. So you would have certain people who are or ESG rating agencies that will view a company or a fund as not sustainable or sustainable, and there'll be different perspectives. So you see this in a lot of the media outputs now, right? Should defense be part of an ESG fund? Why would an ESG ES or sustainable fund hold fossil fuels? And so these are differences in concepts and views of how you should put together and what should go into a sustainable fund. That is different to the other concept, which I'm going to lay out, which is companies or asset managers overstating and making claims that are not backed up by what they're actually doing. And I think the solution, and for companies and for funds is too, and I think reporting and transparency is basically the key. So for the first one, you are inevitably going to have different views on what is sustainable. I think if we look at the EU taxonomy conversation on nuclear and gas, that is an example of that. There's not necessarily a right or wrong answer. You could have reasonable people make different arguments. Now, the only way you can battle that is, I think, transparency, where you may not agree with a particular fund's sustainable, their sustainability philosophy, but if you can see what that philosophy is, you can see how that affects the portfolio, you are able to take a judgment around it. And so that's the first pillar, I think, in terms of battling greenwashing, is reporting and transparency. And we're doing that by trying to make as much information available, be it through our fact sheets when it comes to third-party ESG data, as well as proprietary ESG data, or collecting voting data, for example. So improving the way our investment teams and analysts are able to record the data of who they engage with, aggregate that so that people can see. Now, the second bit, which is making claims that overstate what you're doing, I believe the only way to do that is to build evidence and have a governance process to be able to understand how ESG is being implemented and integrated into the desk. And then being able to, if a stakeholder, be it a client, be it a regulator comes, to be able to offer that evidence. And so the way that we have looked into this is to build what we call a sustainable accreditation process. So each desk has to build evidence when it comes to how they've engaged with companies, what investment decisions have they made using our different ESG tools, what is their overall investment philosophy. And there is a ESG integration desk that sits outside of that investment team who will effectively mark that homework and try to understand that process. And when we build that data and the documentation through this integration process, we can provide that as support to clients or to regulators who are asking about our process. And so that evidence building is key, because a lot of these things, when it's like, okay, are you considering climate risk in your portfolio? There's not a simple answer. You can consider climate risk in all sorts of ways. And so to really be able to answer that question, you just need the evidence of how you're doing it and what processes you're doing it. And I think that's the key. So I'll summarize that to basically reporting, transparency, governance, and evidence is the key to battling greenwashing.
Thank you. So in other words, measurement, it's very important, whether you're a company or a fund manager. So reporting and measurement. So maybe now we'll throw it out to Yas and Amundi to see what you think about that question.
Okay, well, I think the building on to what Marvin has explained, I also like to sort of mention one thing, which is the European regulatory sort of pressure or requirements. Well, you probably sort of heard about the Article 8 or Article 9 or Article 6, all those things. They are sort of a requirement under SFDR. It is a sort of a series of requirements laid out for mostly for financial market participants, including fund distributors or fund managers like us, and even for asset managers. So this is a sort of a kind of a discipline being implemented in the EU, and in accordance with the sort of regulation, we have a sort of a 2 layers of disclosure requirements. One is entity level, the other is individual product levels. So, like Marvin saying, it's about sort of showing evidence, show and tell what you are doing, and if you are sort of interested in any ESG fund, and if it is a sort of EU managers one, then first thing you should do is go visit their corporate website and see what they say. Firstly, what their sort of investment philosophy. Do they have a good enough sort of policy related to responsible investing? Amundi has one, of course. And also, if you sort of, go to, if you speak with the, your service provider, probably, it's got the some pieces of information related to another regulation, MiFID II. And it is about the asking more transparency to fund distributors or fund advisors vis-a-vis the levels of sustainable investment. And well, long story short, any product must have the sort of a percentage of sustainable investment in its portfolio. And it's got the sort of two sort of criteria based upon the EU taxonomy and the SFDR. But well, all those sort of nitty-gritty details aside, you should sort of really think about, okay, what's inside your portfolios, and compare it, with the sort of characteristics of those non-ESG portfolio. If they are similar, then you might want to sort of have a sort of another sort of a conversation with the service provider, or you might sort of want to revisit your sort of a choice being made. So there are sort of increasing number of disclosures, especially in the EU, and you have a sort of all those pieces of resource that are available even in this region. So check it out.
Thank you. Very, very helpful. So it looks like, ESG investing is very much more advanced in EU versus the US. So I used to work in the US, and I think there's still a long way to go there. But what about Asia? I mean, both of you are taking care of the Asian region. What do you think we can do better?
I'm happy to start off with this one. I was going to object to this automatic concept of European being more advanced. And so I guess one example of this, I think Yaz talked about SFDR and the classification process. Now, I think SFDR has given a lot of information and data, be it principal adverse indicators, be it sustainable investment percentage. It gives a lot more information for people to work with. Now, however, I don't think it's a silver bullet or panacea to solving this greenwashing problem, because if you look deep into the data, many asset managers have different process, and so the definition of percentage of sustainable investment is going to be different. The way that asset managers define an Article 8 or Article 9 threshold is also different because they have different processes. And so it doesn't remove the need for investors to really look under the bonnet and really really understand what an ESG strategy does, and it just gives you more data to do so. And we have seen this evolve and being applied to parts of Asia. So we've had the Hong Kong requirements when it comes to retail ESG funds. We've seen a similar version in Singapore. There's a lot of things happening in the region. I would say actually one thing I have seen that in Asia that in some ways maybe arguably ahead of Europe is the focus on environmental risk. So MAS's environmental risk management rules, Hong Kong's climate-related SFC climate-related disclosures. I mean, and it's happening in other parts of the region as well. And so the process, the conversations about how to truly analyze transition risk and physical risk, how do we manage scenario analysis, I would say in Asia is as sophisticated as the conversations that I've been having in Europe. So instead of, I guess, thinking ESG is this kind of one thing, it's actually many elements. And I think actually there'll be places where we're maybe less ahead, like maybe something like impact investing, which I would argue is maybe more ahead in Europe, but there'll be things like climate risk and I think also transition finance where Asia, you could say, has taken the lead. Thank you.
Yes, do you have anything to add?
All right. Well, I think I tend to sort of agree with the Marvin's comment in that there's no silver bullet for sure. But the important thing is we have certain kind of a discipline to follow up on, and we're talking about sort of Asia. Well, in particular, sort of climate. I would say sort of climate is a sort of a bit different creature amongst all those ESG sort of factors, because it's got a certain kind of a common quantitative sort of metrics, which is GHG, and well, how you sort of interpret or how you sort of use their sort of portfolio construction can vary from one to another. but at least we can have a touch and feel. Okay, now how much of your portfolio has a sort of lowered its GHG emission against the reference benchmark? You can tell. And also, trajectory wise, what is the sort of the portfolio's overall sort of alignment with the transition goal. You can sort of refer to GHG or sometimes portfolio temperatures these days. So there are sort of good enough pieces of information that you can sort of use when you evaluate all those climate change related products. And I think for sort of in the Asian region, on the back of the regulatory requirements from the sort of respective sort of markets, then investors are asset managers are sort of required to sort of disclose those pieces of information, and which I think is helpful for the final investors.
Thank you for that. So just to add to, and thank you both of you actually for acknowledging that greenwashing is also a problem for asset managers and fund managers. It's not just the companies. So at Endowus, what we do is we really dig deep into the managers' processes, research process. We have multiple conversations with our partners to really make sure that if we're saying that a fund is focused on ESG, that it actually is. So, we're trying to do part of that eliminating greenwashing part for you, our clients. So, it's easy when you have partners like Amundi and Schroders. So we definitely have their ESG focused funds on our platform. So you can definitely take a look if you're interested. Okay, so for the next part, will be the last question. So we've talked about the past, how we've seen the flows into ESG related investments. We've talked about the current environment with inflation, everything that's going on. Now, I think it will really help our audience if we can talk about how to frame ESG investing going forward. 1 year from now, what should they expect? Should they expect that maybe ESG investments, and this is just me throwing it out, are going to perform similarly to non-highly rated ESG companies? I'll let maybe Mervyn start first this time.
Sure. Again, I would not kind of group ESG and strategies into one whole, but what I would say is that ESG will become even more sophisticated in the future. We've had lots and lots of disclosure requirements, be it corporates, be it financial institutions, be it at the fund level, all across the world. Now, with disclosure, you need to be able to understand and analyze that data for it to be used effectively. It's like just having a piece of data doesn't work by itself. And so linking back to actually the conversation about Asia as a leader, one of the things that came up was if we talk about carbon footprint, for example, kind of a requirement with HKSFC, we actually have a strategy that's focused globally on investing in energy transition technologies. So this could be things like wind turbines, it could be building insulation, it can be solar panels. And if you look at the carbon footprint of that portfolio and you compare it, let's say, to a broad-based index like MSCI ACWI, it's actually much higher. And that's because if you think about, let's say, what companies produce solar panels, what companies produce wind turbines, they're manufacturing industrial companies. As sectors, they are more carbon intensive. They're going to be more carbon intensive in scope 1, 2, and 3 emissions than a retail company or a tech company. Does that mean, as someone who is worried about climate risk or wanting to invest in climate opportunities, I shouldn't be investing in these energy transition technologies? Intellectually, of course not. So one of the things that we thought about here, and we worked with Singaporean sovereign wealth fund GIC to produce a report on this, is what we call an avoided emissions framework. So this framework looks at, let's say, for wind turbines, how much does it contribute to the value chain of wind energy substituting for for fossil fuel energy, and what does that mean for emission savings system wide? Now, it's not easy. There's a lot of assumptions that are made, but it's important for us to consider climate solutions and technology in a way that allows us to assess their benefits to society, as well as the potential demand boost they might get in a world which is moving to low carbon transition. And I don't think that's the only innovation that we'll see in terms of ESG analysis. There's going to be more sophisticated thematic frameworks. There's going to be more sophisticated projections of decarbonization pathways. And so it's going to be difficult, I think, for investors to navigate some of this, but I think that's the job for yourselves as those who select funds, as well as asset managers like ourselves, to incorporate that data and information.
Thank you, Mervyn. Now I'll turn it over to Yas.
Okay, well, I like to rephrase this question. I would say investors reconfirm their expectations. And on that note, well, can I sort of go back to the slide that I have skipped? It's titled as a different objectives and methods. Yeah, thank you. Yeah, this one, right. Well, Mami has sort of discussed the, I would say, sort of a rather bottom-up kind of approach, when sort of thinking about the ESG investing, and mine is more of a top-down. And well, I'm not sort of telling you sort of anything special. It's very basic. It's about understanding your objectives, like I have sort of commented earlier on. And depending on the sort of your objectives, your sort of a choice or your choices will be different. Methods will be different. And like Marvin saying, we can't put the, we don't have any single solution at all when it comes to ESG investing or responsible investing. Why? Well, there are sort of a different sets of objectives in addition to risk return sort of objectives. What are they? Well, in Amundi, we tend to sort of group them in 4 buckets. One is your values. 2 is a risk mitigation long term. It may not just be a sort of a market risk. It could be a sort of a, the famous physical risk or a transition risk for, climate changes. And the third one is, sustainable performance. Again, it's a long term, okay? So you have to sort of, you have to be ready for sort of accept the market rotation and whatsoever. And the last one is a bit different. So generate impacts. So depending on your sort of objectives, your choice has to be different, okay? So there are sort of, exclusions, which rather sort of simple. And thematic investing, this is sort of tend to be more pointed to certain sets of SDG goals, maybe. And it's your choice, but you have to understand the, okay, what you're sort of buying. What are your sort of exposures? By sort of choosing this and that sort of investment product. So on that regard, you should sort of work with the sort of trustful partners like Endowus, and also asset managers like ourselves. And one more thing is, when it comes to ESG investing, I would say there's always a sort of there are sort of 2 sort of goals, I would say. One is economic returns. The other is doing something good or contributing something to addressing issues in the E or S. And depending on the sort of weightings, between the 2 of yours, then your choice should be sort of different. And if you have a sort of a good enough the objective to begin with, then you can be, again, patient enough and stick with the sort of investment decision you're making.
Thank you. So we have actually quite a number of questions. So I think it's time to go into the Q&A part of the session. So if you don't mind, I'm just going to read out a question. There are actually a couple of questions with regards to costs. And this is just going back to what the 2 of you talked about, with your approaches, with all this, the research, the framework that you've developed. all the resources going into, there is the perception that ESG funds are actually more expensive and of higher cost than a fund that is not focused on ESG. Do you think this perception is accurate? And also, if it is, why? And if it is not accurate, why not? So I think for this, I'd like to open it up to Mervyn first.
Sure, happy to answer. So I think the distinction that I made before between ESG analysis and integration and sustainable strategies is a really important starting point here. So I think one of the changes in the industry, and you see in terms of the signatories to UNPRI, is a recognition that a lot of these environmental, social governance factors are financially material to the companies we invest in. And so in terms of performing the fiduciary duty, we need to be able to understand these risks. And it doesn't mean automatically investing in more sustainable companies, or like you might be thinking about improvers, you might be thinking about lots of different elements, but you still need to have the information and data to be able to analyze these issues. And I think what has changed in some ways is that there's a huge amount of data now available that we as asset managers need to expand our resources to be able to look at. But this process, because it's part of our investment process, it applies regardless to an ESG fund or a non-ESG fund, because this is part of really looking for companies that will potentially outperform, or we can to understand the risk of those companies. Now, that's different, I think, to sustainable strategies, which is then the point, okay, ESG funds versus non-ESG funds. And I think in that context, like in the non-ESG world, costs reflects complexity. And so if you have a broad-based index with, let's say, a very basic ESG exclusion or some kind of criteria, it's not going to have that much of a cost difference. If you are starting to ask for a very concentrated portfolio that has specific SDGs being targeted with a specific engagement plan, or let's say focuses on climate, the transition technology, the amount of work to build that portfolio, to understand what the sector, like what the factor exposures are, what the dynamics are, it will reflect higher costs. But even you see that in a complex non-ESG fund as well, right? This is not an ESG thing, this is a complexity issue. And so I think when it comes to ESG, I think the key difference is, I guess, where Yas mentioned is it's not always just about risk return. There is that additional sustainability objective for a subset of clients. And to accommodate those sustainability objectives, it needs more data, it needs more investment analytics, and it requires more process. And that's where you see the costs. But that's not necessarily for all ESG funds or all ESG strategies. And so that's how I would, I think, characterize the cost difference across different sustainability strategies versus non-sustainable ones.
Very well put. Yes, would you want to add anything to that?
Well, I think sort of Marvin has covered the sort of key elements, and well, at the end of the day, if the sort of products can deliver a sort of a good enough value, in light of your risk return profile and also sustainability preference, then there must be a sort of a reasonable sort of levels, and well, it's not sort of a I would say it's a sort of sort of relative at the end of the day. And if you're looking for sort of something sort of market return like with some sort of light future of ESG, then your choice may be I don't know, ESG ETFs. That's fine. But if you like to go on with a sort of a long-term sort of growth, growth of companies whose business model is sustainable, and you expect the fund managers to work with such corporates, then it'll be sort of lots of work involved. And but if you believe in the value it creates, then your sort of I would say reservation price will be sort of tends to be higher. So that's my sort of 2 cents.
Thank you. Thank you. That answers. I think that those are very good answers and very good reasons. So I want to actually maybe switch gears a little bit to something called transition finance. I believe both of you may have mentioned transition finance, this term. So maybe I'll just open this up to Yas to kind of talk about what is transition finance, just for the audience, and whether investing in funds that are focused on transitioning companies are going to make more of an impact than investing in funds that already have really high quality, high ESG score companies.
Okay. Well, like Min saying, it sort of encompasses sort of a different sort of types of economic activities, I would say. And one way is sort of a transition of the existing sort of corporates and who has a sort of right trajectories toward 2050, and encourage them to carry out their GHG reduction plans. That's one way to sort of look at the sort of promoting transitions of corporates. That's one thing. Another thing maybe is what Marvin was sort of referring to, all those technologies or enablers, and we need sort of lots and lots of innovations in order for us as a whole to achieve the 1.5 degrees target. And it depends on the sort of innovations being materialized, and so we need to sort of figure out the finance such sort of economic activities on R&Ds, and that's sort of another way. And related to the sort of impact, I would say it's more of a sort of the first type I just mentioned. And you can show the sort of progress of the transition by looking at the GHG avoided emissions, for example. And we have a sort of metrics to report on. And if you are sort of interested in the transition finance, then you should watch out those sort of figures.
I'll just add, I think with transition finance, it's an issue that I think reflects the previous point I made, that there can be different views on what is sustainable and not sustainable. And so for me, the core of the transition finance debate, if we talk about things like gas or nuclear, is should they be part of the decarbonization pathway? And whether you think they are will depend on what you believe the speed of energy, what you think the energy needs would be, what you think in terms of the importance of energy stability when it comes to, let's say, emerging market economies that are growing, and the pace of decarbonization that's needed while balancing those things. And you have people, and then there'll be maybe in certain regions, there'll be certain policymakers, there'll be certain stakeholders who may think that, you know what, gas and nuclear should just not be part of any transition strategy because climate change is urgent and we need to just go there now. And there'll be others who go, maybe like actually we have a lot of developing economies out there who have still very low income, and we need to manage that pathway, and we need to manage the costs of that transition process. And that may be that could involve developed markets providing funding and subsidies to developing markets, or it could mean incorporating nuclear or gas and other transition finance for a period of time. That is an economic and political debate that is ongoing and will continue to ongo. Now, I think with transition finance, that doesn't mean that we just go, oh, there's going to be different opinions. I think there are ways to improve our overall ability to invest in this concept. And with transition finance, and we see this with the MAS convened Green Finance Industry Task Force, and what they're doing with the taxonomy is, regardless of how you take that previous philosophical economical argument, you can put thresholds to transition finance so that each side is able to accept that as a transition strategy. So, you know what, maybe nuclear is useful for until 2030, until 2035, until 2040, or maybe for any gas plant, it must have a certain energy efficiency or carbon intensity of X or Y%. But by putting those thresholds together, you can then find a more optimal transition strategy. And I think that's where the key to transition finance comes. It's, can we develop a better process, be it through metrics, be it through threshold, that we can all agree on? And then there will be the second question of, there'll always be people who don't think certain energy sources should be part of the transition process.
Thank you. Thank you for your insights. We have two more questions that if you have time, I'd like to just quickly answer. So I'm just trying to look at the questions here. There is a question, one of our, the participant is asking, Do you agree that ESG funds may just be picking companies that are benefiting from climate change rather than actively innovating and improving emissions? So I'll leave it to either of you to answer, whoever wants to answer first. Maybe yes.
Okay, well, maybe sort of, well, I would say it's a sort of combination of both at the end of the day. And, there are sort of, enablers, or, they are sort of who have sort of already adopted to sort of climate changes. And, I think, it both, address to, I mean, sort of, those two will be sort of, both of them are sort of components of, climate finance, I would say.
And I would add, I think well, first, whether that's true will depend on the type of strategy, and whether you want to invest in that process will, I think, depend on, not only your theory of change, but your objective. So if we're talking about, let's say, you know what, I care about the carbon footprint of just, I believe that actually, regardless of how companies improve, I just want the lowest carbon footprint portfolio now, because I believe that's the best way to push the world towards a lower carbon run. Then you go for a very kind of that portfolio that is fully focused on that carbon footprint. But if you're like, okay, I believe that actually I want to invest in energy and enablers or transition technologies, and I might have a few reasons for that. I might be investing in that because I believe demand for those technologies would increase in a low carbon transitioning world, or I believe that it has the best environmental impact because you need that technology investment to be able to facilitate systemic decarbonization. Now, again, like, there's going to be different theories of change. There'll be going to be different theories in terms of how the valuation and demand is going to change for these particular types of goods and services. Now, again, like, it requires taking a view or having an idea of what your objectives are and what you're trying to achieve.
Okay, so it sounds like there's a lot on the menu. You can just pick the dish that suits your palate. Would you say it's fair to say that?
I think to be able to effectively pick the dish, you need to understand what's in the dish and also know your own tastes and preferences. And I think that's where, in many ways, education is core to, I think, the growth of the industry. We need to be able to teach what are these concepts that we're introducing to this world in terms of in the investing world. How do we analyze all this information and data? How do we analyze this percentage of sustainable investment or PAI indicators? Because otherwise, it's just a lot of information. Like, how do we then also, okay, what kind of objectives do I have? Do I care about all SDGs, or do I care about some specific SDGs? And I think this is something that's quite new to many investors out there in the market. And I think that's where the education process comes in.
Thank you. JP, do you think we have time for one more question? Or okay, so we'll just do one last question. This is also from Slido. Given the inconsistent implementation of these ESG frameworks, so we've talked about how there are different frameworks, how do you think we should go about addressing these issues? How should investors think about, like the broad picture? There's so many different frameworks, which one is good, which one is bad. So your thoughts. Maybe let's start with Yas, if that's okay.
Sure. So when you say frameworks, and it's a sort of approaches, I briefly sort of mentioned, and correct. And well, I think this answer is a sort of individual investor's mind at the end of the day. And if you care for the investment returns, like almost close to broader markets, then you would sort of think about sort of choosing something lighter approach like exclusion, maybe. And if you sort of care sort of sector rotation, you might want to pick and choose the something called best in class. Best in class, invest in the literally best in class in the respective sectors. And by so doing, you can have a somewhat balanced exposure to sectors while you appreciate the sort of elements of ESG. This is another one. And again, if you really sort of have a strong opinion about climate change or any sort of social issues, one way is to sort of invest into green bonds portfolio. They can report out the impacts, and also social bonds too. But if it is a sort of social bonds, chances are that you have a sort of bunches of information about the impacts, because there's no sort of a common sort of metrics to evaluate or evaluate the social impacts through the investments. But again, it boils down to the sort of investment objectives always.
Absolutely agree with Yaz on this. I think it's interesting. Like, one observation I have is you never hear people talk about the inconsistent approaches to financial analysis or investment of asset managers, because that's what you expect. And I think that the key here is there's kind of two parts to ESG, like I mentioned, the integration part. And the integration part, if you are only doing ESG to kind of optimize your long run risk and return, then the question is, okay, you will be able to bring evidence through performance in the longer term. And so it's not as easy as looking at your 1 year performance, but it gives you an idea of, you will be able to have performance data in the future to understand if you've achieved the objectives that you're looking for. Of course, you need to break down that performance in terms of risk and factors and all that other stuff, but there's performance. The harder bit, I think, is when you are investing in ESG for sustainable impact or some kind of values or some kind of objective, because you don't have that ex post data point to say, I've achieved my sustainable approach, because every sustainability approach will be based off of a concept of sustainability. And so, of course, you're going to invest in what your model says is more sustainable. And so whether that's successful or not ex post is again, it doesn't actually tell you. You're marking your own homework. And so I think in that world, it makes it even more important than I think traditional financial analysis is to understand your asset managers, well, this particular strategy of the fund, but also when it comes to the asset manager, what kind of resources do they have? Like, are they doing what they're saying they're doing? How are they implementing this? And what kind of evidence do they have? And can they find different frameworks to measure and show impact? It is much harder, but unfortunately, we don't have a Sharpe ratio to tell you if something is a good or bad ESG fund in 5 years' time.
Maybe someday we will. But with that, thank you so much. Let's wrap up this session. I just want to thank our guest speakers again today. Yas from Amundi, Marvin from Schroders, and also our audience for staying with us just a few minutes past 8. Thank you so much, and I hope you all have a great rest of the evening.
Thank you.
Thank you.